Good morning. This is Ken Long from Tortoise Capital Management with a review of the weekend trading reports for March 31st, 2013. Happy Easter edition. Thanks, dogs. Market is in bullish normal conditions. On a long-term basis, it's at 75 on weekly RSI 14, putting it well into the overbought conditions. On the 10-day NDX, it's at 94 out of 100, so in both cases it's overbought. Percent stretch relative to the 200-day moving average is green bullish at 10.11%, and the slope of the 50-day moving average is white bullish at 0.64%, so that's positive. ADX is at 20, so the sideways trending action is continuing a little bit here. ATR percentage remains low at the low end of normal here at 0.80%. The risk index, which is the 30-period moving average of the VIX divided by the 10-period, is at 1.02, which is right on the boundary of risk on, that boundary being 1.0. The z-score of that value, 1.02, the z-score is 0.17, and you can see the time series here where the as volatility has increased a little bit, it's coming back to almost risk neutral. Blended monthly rebalancing portfolio rotation now in the 26 ETFs, it's going to be U.S. mid-caps, Japan, then U.S. financials. In the 13 ETF, it's U.S. mid-caps, Japan, and then U.S. small caps. The next reevaluation should be on or about 1 May. Theoretical exposure in the ETF2 model is at 80%. The model portfolio is at 100%. And this week we're updating stops. The IYT position, the Dow Transports, which has been one of the strongest sectors going, was adjusted due to dividend payouts. The YouTube.com channel, Kennifer 8, has a number of new short-term trades from that chat room. Probably the easiest way to stay on top of those is just to subscribe to that channel. Looking at the portfolios, again, you can see for blended monthly, you see Latin America, emerging markets, and treasuries are on cash positions. About half of the 26 ETFs are on cash signals. Most of these are bonds, internationals, currencies, ag, and meanwhile the strongest continue to be the strongest with mid-caps, Japan, financials, U.S. small caps. Australia remains pretty strong. And the Dow is in front of the S&P, which again is favoring those mature large cap consumer staple type companies. The regional report from ETF2, again you can see 8 out of the 10 sectors are on buy signals, so that leaves us at 80% invested, 20% cash in the theoretical model in terms of going forward. SPY is better than EFA. SPY at 57 is better than EFA at 53. When you look at the average roll up, it's 65 better than 64. So the trend of rotating back towards the U.S. continues in force and getting a little stronger. Inside the U.S., strength is mid caps at 60, then small caps at 59, then the large caps at 57, and then the tech at 52. The two strongest sectors are mid caps and small caps in the U.S. at 60 and 59 respectively, and the two weakest are Latin America and emerging markets at 49 and 47 respectively. World market model, the U.S. is all above average now, even tech, and the mid caps, value and blend especially, are exceptionally strong. Europe has tipped now to mostly below average, but with a few leaders holding out: Sweden, Belgium, Switzerland. The strong countries it's kind of the emerging Asia, if you will, in Asia less Japan, are still strong. Thailand, Philippines, Indonesia, Vietnam, and Australia remains above average. Otherwise, Asia is below average. Japan and Asia less Japan, the aggregates are still above average. Latin America, emerging markets, Canada, Brazil, all lagging. Mexico slightly above average. Gold, silver, and treasuries lagging significantly. The private equity ETF, PSP, is well above average. Real estate moving above average in the U.S. Comparing the business sectors, a balance in materials, tech, healthcare. Otherwise, the U.S. is dominating. We get tech lagging, staples and healthcare leading. Again, this is I still think this is a form of the risk-off trade. This is exposure to equities, but favoring the large caps and mature companies that are making some money going forward. In the middle of economic uncertainty, you go with what's growing, and so staples, utilities, and healthcare seem to be working. Top 30 ETFs based on the ETF2 model. Philippines now is in the #1 position. Japan continues to do well. That master limited partnership here, this MLPN, again, it's a energy sector play. Vietnam at the top. Really little change week over week. The ones that are adding money we know are things where the strength column is green, but say the consistency or the average is white. And remember, the consistency is a 10-week average, an indexed 12-week average of the strength column. So when the strength is up and consistency is white, then that says that there's current strength being moved in. So that's this MLP infrastructure, dynamic media, the MLP index, healthcare, Vanguard mid-cap value. That's a nice way to play the entire sector too, by the way. And even this broad fat index here, MDY, making the top 30 list is an indication of just how powerful that move in the U.S. is. I would hypothesize, if I was trying to tell a story about it, I would just say it's a combination of the U.S. and growth on and a broad index, with the belief being that maybe there's more room for growth in mid caps rather than large caps, and that's maybe why that sector is pulling ahead. That is a persistent trend. Inside the Dow 30, again, importantly, all of them are out of the red, and even the weakest one is up around 47, which is Alcoa. The strongest continues to be Hewlett-Packard. It just continues to knock it out of the park. It's up to 23.8 now. That's over 100% move since we first started trading it as a washout pattern. Travelers, American Express, Johnson & Johnson, Boeing are all the other remainder in the top 5. We're starting to see some of the other financials lag a little bit. Bank of America is coming down. JP Morgan has fallen out of the top 5. Coke is moving nicely off the bottom. And using that same logic, we would be looking for money flowing into things where the strength is green and consistency is white. American Express, Johnson & Johnson, Boeing, Pfizer, Home Depot, Procter & Gamble meet that kind of bill. And now for the opposite view of that, you can see that JP Morgan on a 10-week basis is still green at 82 and still very strong on a 10-week basis, but in the strength column, which is the last, which incorporates the last week's worth of performance, and current strength it's moved back into the middle of the table. In the same way, Walmart, on the other hand, is getting better because it's at 54 in the white but 62 in the yellow. On consistency, that's money flowing into Walmart as it continues to move off the bottom as part of that consumer staples play. So Merck, Intel, United Health all have that quality too of perhaps being lower in the table and starting to move off as a value play. These ones that are green in strength and white in consistency are ones where that value play is fully manifested. These other ones are still cooking. The opposite effect is Caterpillar, where you have yellow in the strength but white in consistency. That divergence is saying that Caterpillar is getting relatively weaker. Significantly, Caterpillar and Alcoa are at the bottom, and they're the only ones that are below their 4-month moving average, which puts them on a cash position. So there's some utility in this chart because it allows you to see some important conditions, near term and longer term. ETF liquidity, just a review of the top 30 by average daily dollar volume. Small caps continue to have 50% more trading volume than the technology, so that's really the trading vehicle that would be preferred in my view. The VIX and gold miners continue to be exceptionally volatile and liquid, so for intraday trading, that's some possibilities. And we'll shift now over to the daily report. I won't reread the top section. You can see in the 10-day NDX time series here that we've been overbought now for the last 3 or 4 days, so that still looks powerful. The reading on the VIX at 12.7 puts it very near the lower boundary of normal, which would be 12.19 based on the last 20 years of the VIX. So still, even though the slightly moving towards risk off, the VIX has been extremely low. So there's still some possibilities for shock up moves and in volatility trading. No signals in overreaction and channeling. You can see the volatility based on ATR percentages resting right near the bottom of the normal range, so that's still very healthy. So the trendiness has been pulling out of the market over the last 15 or 20 days with some sideways work coming in to grade the quality of the bull. 10-day max pain candidates, JP Morgan, Bank of America, that used to be the top, the front runners in the Dow, if you will, have pulled back somewhat. Maybe a potential buy on dip opportunities there if we see continued strength in financials. But in my view, the Travelers and American Express are ways that I would consider playing that instead. So on a given day, if financials are up, you could compare the new versus the old and see where the strength is to get it a little extra juice out of the financial sector. Channeling and overreaction signals, JP Morgan, Bank of America, Chevron for channeling. Triple screens, there you are, Bank of America and Chevron. 551W in the Euro-Asia blend and DuPont. And then in the auto framer, these are all ones that test out better than 2-to-1, just based on trade location. VIX, JP Morgan, Cisco, Cliffs Natural Resources, which has got hammered again this week. So creating some opportunities for some deep value rebound trading. Europe, Brazil, gold, and then Bank of America rounding out the auto framer positions. In the Dow Tactical, get three dojis in Cisco, General Electric, and Walmart. Channeling and overreaction in JP Morgan and Bank of America. They should be of interest also because they're single digits on the RSI2. Bank of America has a 2 on RSI2. It was a % loser on Friday. That's why it's coded red. 2.3 on the auto framer reward to risk ratio. It's the number 3 play in the max pain range compression, and it's a triple screen. So you basically have to be interested in Bank of America. You can see long term over the last 6 and 12 months, it's had exceptional performance compared to its peers, which is why it's coded green here. But this recent pullback provides the opportunity for potential buy on dips, and that's what those kind of patterns are showing. Hewlett-Packard and United Health, Travelers, again, you can see those were exceptional one-day performers. Travelers should be of interest because it was a big winner Friday. It has a 3.0 frog quality number, and has also been exceptional on the 6 and 12-month periods, and that's in the strong financial sector. A continuation pattern there would be a reasonable trade to frame, and I'll cover that in the webinar. Among the tacticals, only a few pattern trades, really just the 551W and EFA. Quite a few test out well on the auto framer, coal, Europe, the VIX, Brazil, and EFA. Only silver gave us any indication here on the RSI2, but has no other qualities to commend it. So more opportunities in the large caps than the ETFs necessarily. Market mosaic. You can see the slight weakening, sideways weakening. This is different than the weakness that came about from this kind of shock move and then recovery, but there's been a little degrade to the upward movement. The nice thing, though, is it looks like some support developed here at 154. Friday closed at a new high. So there's some possibilities to carry over into the new week after the Easter holiday. That slope of that regression line plotted against its 10 periods still shows favorable conditions. We're at less than one standard deviation, so there's still room for this to go. 3 or 4% still available on the upside based on the looking at the regression line slope and then also the percent stretch above the 200. So this would be considered a natural resting spot on the next leg up if we can see some more momentum here next week. But that a favorable close on last Thursday. We'll just take a quick look at the additional indicators here for reference, just reference scores. I would point out that the strength in EWJ, is showing you that over multiple time periods, Japan has been pretty powerful, contrasting to the weakness in Caterpillar and Alcoa as they move down the list in the Dow. Those are the two at the bottom. You can see over the last 40 days, Caterpillar's losses are a full standard deviation below its 10-year average. XLP, on the other hand, has been turning in some historic gains over the last 40, 20, and 10 days. And you can see over the last 40 days, it's got a Z-score of 1.6. So that's really an exceptional move in XLP when compared to its historical norms. You can see in the NASDAQ Z-scores significantly lower than those of the Dow and the S&P, which is, again, that Apple effect and the general lagging nature of tech lately. The Z-scores of the regression line slopes, the 90 is still at an exceptional move up. You can see that the weakening of the sideways movement, if you will, the failure to follow through of the last 10 days has caused that 90 to start rolling over. The good news is that strong closings in the last couple days of last week have brought the 30-period regression line up to almost 1.0, top of the channel, and the 10 has turned around. You can see that little resumption of this trend. We got to see here if the holiday spirit carries over into the next week and moves it forward. If it does, then there's another 5 or 6% above on this next leg up if that can hold. And we'll just flip through the remainder of the reference charts. You can stop the tape and review the ones that you like. Let me come back to this one here. This 30-day relative strength score. This is the score of these various indexes, the slope of the regression lines after we've factored out the market. So this is market neutralized or normalized. And what you can see is the strength in MDY, how that is really the U.S. index that is getting the focus of attention here on buying power. It's already above 1.0, and you can see, I think, money rolling from the Dow into MDY. So that could be signaling the next stage, and if we get a leg up here, and maybe it's not the large cap companies which have been doing really well and are continuing to do well, but maybe now the shift is going towards a little more growth and towards the U.S. with the mid caps. And you can see that they're pulling ahead of the small caps. Inside the commodity complex, it's oil up while the blended commodities and gold relatively down. And even emerging markets starting to do pretty well here. I'm concerned a little bit about Japan's sell-off in here, but what are you going to do? You got to take the signals that you take, and just live with them according to the system rules. Okay. And that's the summary of the strategy report for Monday. Going into Monday, keep your powder dry. Enjoy your weekend, and enjoy this Easter holiday with friends and family. So take good care, and we'll see you in the chat room.